Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short. My name is Alex Cho, and today I'm just going to go ahead and review my worst tech stock list of 2011, and I'm just going to make a new edition and go ahead and go over my previous one as well. So let's get to the facts. My newly added worst tech pick of 2011 is currently QQ360. The current price to earnings ratio is around 345. We have no analysts projecting future earnings or earnings growth, so we can't really put in any growth metric on the stock. Market capitalization is 2.9 billion. Company currently has around 8.9 million in net income annually. So basically I divided the net income by the total market capitalization and I got 345, which is the price to earnings. The price to earnings is a bit over the top, at least from a lot of what I've seen. And again, you know, great growth potential. I mean, don't get me wrong. I think it's going to be the Norton antivirus of China. And it already is for the most part. But at the same time, $2.9 billion, a bit hefty for a company that only makes $8.9 million in net income. And also, if you guys notice, a lot of tech companies like Baidu, the Google of China, has had a huge run-up, and then it pulls back drastically, even down to pre-IPO levels. Now this stock had a huge run-up. I mean, it opened up very positive. It traded positive throughout the whole day, and then it has continued to go lower. So this by far has to be one of my worst tech picks of 2011. Don't get me wrong. I don't think this company will go bankrupt or anything like that. But I think the company is a bit overvalued. Again, the main reason why it's overvalued is that we can't project their earnings as of right now. No analyst has decided to step up to the plate and give us any real concrete information as to how much we can anticipate this company to grow. And I think there's not a lot of people covering it because it hasn't been on anyone's radar until they announced their initial public offering. So that's going to take time as well. Until we get some more information out of this company and what they can produce as earnings and see their historic management effectiveness, it's going to be very hard. A lot of people are selling the stock, and justifiably so. Another thing is that a lot of companies that were investing into this company at its much earlier stages, when they were looking for angel investors and venture capitalists and stuff like that, those people are taking the opportunity and selling it on the US exchange, most likely. And another thing is that the company is a bit overvalued. 345 price to earnings is ridiculous, especially since we can't project out the company's growth. And over the short term, throughout 2011, I think this stock could go down to a market capitalization in the $1 to $1.5 billion range. And if the company is trading at around 1 to 1.5 billion market capitalization, that basically means that the stock could easily trade anywhere between $10 to $14 per share, unfortunately. And that is a really, really low number compared to the current value of around $25.58. Yes, it's going to be a huge blow on the stock. I mean, and $10 to $14 is, I guess, a reasonable valuation. I've seen companies with more potential coming out of China trade at these valuations of anywhere to 1.5 billion. This is just a virus, you know. I mean, a virus scanning company. Last time I checked, Norton antivirus. Or it's basically the company is Symantec, and they trade, at basically 13.9 billion market cap. So this company is already a third of the value of Symantec Corporation without producing the earnings to support it. I mean, right now Symantec Corporation has around Just for you guys' reference, $714 million in revenue. This company only has $7 million in revenue, or net income, a far cry from where it should be at. And even with a $753 million in net income for Norton, Norton's only worth 13 billion bucks. So this company, even if it grows at a really fast rate, it still is a long way from fetching a $2.9 billion market valuation. Eventually, I could see this company worth 10 billion bucks, but that's going to take many years, maybe 3 to 5 years, for you to fetch a return. So again, I would avoid this stock, or I would short it over the longer term. Great opportunity on the short side, not much on the long side. Moving on, I'm going to go ahead and review research in motion again. Since I've already talked about the fundamentals and a lot of technicals, I will admit that research in motion has had its greatest year amongst all years, but they've missed analyst expectations, and once you slip, people anticipate you to keep on slipping. Another thing is that we have the formidable head and shoulder pattern. Nobody argues with the head and shoulder pattern. Any market technician will tell you, don't argue with the markets, just go with it. And I'd have to agree. You don't argue with the head and shoulder pattern. If there's any pattern you want to avoid saying, you know, I think fundamentals matter more than the technicals, well, in front of the head and shoulder pattern, it means nothing. It doesn't matter whether or not the company has had the greatest quarter earnings. The fact is, they missed analyst expectations. When you miss expectations, you got a head and shoulder pattern, you break below 200-day moving average, you can anticipate the stock to go lower. I anticipate $50 to around $46 to be the range where it finally finds support and breaks out of it. Somewhere around here, anywhere around here is a great bargain hunting opportunity. But until then, I believe this stock is still on my worst tech stocks of 2011 list, and I will switch my bias on it once we get down to that $50 to $46 area. That's when I'm really hungry. That's where I think we got some great opportunity in this company. Anyway, thanks for going ahead and taking out some time to go ahead and sit down with me, talk about some bad, awful tech stocks. And neither of these companies are really bad. I mean, they're not doing anything particularly wrong. It's that the markets have overvalued them a bit. And this company, I mean, as far as Qhoo, overvalued, not exactly the right type of company to be valuing at 3 billion bucks. Okay, it's antivirus, for crying out loud. That only fetches so much money. If it was an online retail company, I would think differently. I really would, but it's not. So again, Qhoo, overvalued. Investors have priced the stock wrong. Research in motion, really ugly technicals, missed analyst expectations, below 200-day, head and shoulder. What more can we say? We don't like it. We're not going to like it. Stay away from it. That's the end of the line. Alright, so again, that's pretty much my view. And if you guys are interested in this kind of stuff, please be sure to go ahead and take out some time to subscribe to my YouTube channel. It's completely free, no obligation, no nothing. You guys just watch the videos and hopefully get some great ideas from it. And if you guys are interested in the same trading software I use, just go ahead and check out the link right below this video. It helps with timing. It gives you a basic idea of how trends work or what type of trend you're looking at. Anyway, that does it for me for today. I'll have more for you guys in the coming weeks and months ahead. Take care.